Between 2000 and 2008, American households nearly doubled their debt, from about $7 trillion to about 14. Here's the strange part. Almost nobody noticed it happening. Because nobody experiences aggregate debt. You only ever see your own. And that's exactly how the most powerful cycle in economics works. Quietly. Today, the credit cycle, the machine that builds booms out of borrowed money, and then builds the bust out of the exact same material. Start with one sentence of economics. My spending is your income. Now add credit. When I borrow, I can spend more than I earn. Which means you now earn more than you otherwise would have. And feeling richer, you spend more too, maybe with borrowed money of your own. Total income in the economy has just grown faster than wages alone could ever push it. But a loan is a time machine. It moves tomorrow's spending into today. And when repayment comes due, the machine runs backward. I must spend less than I earn, so someone else earns less. Notice that nothing here requires anyone to behave badly. Credit growth mechanically adds demand today, and mechanically subtracts it later. That's why debt doesn't just fund the economic cycle. Debt is a cycle. A longer, slower swell rolling underneath the regular business cycle. The machine has 4 gears. Let's turn them in order. Every credit cycle starts in the wreckage of the last one. After a bust, interest rates are low, and balance sheets have been scrubbed clean. The bad debts are written off, and the reckless lenders are gone. The survivors are cautious. Loans only go to solid borrowers, with real income and real collateral. And here's the irony. This is when lending is safest. Asset prices are depressed, so collateral is cheap. Debt burdens are light. The best loans of the entire cycle are written when everyone is still too scared to write them. Then, slowly, profits return, memories fade, and appetite comes back. Now the flywheel starts to spin. Borrowed money buys assets, mostly houses in the modern era. Buying pushes asset prices up. Rising prices make collateral more valuable. And more valuable collateral means banks can, quite prudently by their own math, lend even more against it. More loans, more buying, higher prices, better collateral. The loop feeds itself. And here's the trap. While the loop spins, risk becomes invisible. Defaults fall to record lows, because any borrower in trouble can refinance against a higher price, or just sell at a profit. So the data looks safer precisely because the system is getting riskier. Lending models trained on loop years conclude that the collateral basically never loses value. The economist Hyman Minsky mapped what happens next, and his 3 categories are worth memorizing. Hedge borrowers can pay interest and principal out of income. Speculative borrowers can pay the interest, but must keep rolling the principal over. And Ponzi borrowers, that was his actual term, can pay neither. They stay solvent only if the asset's price keeps rising. Minsky's great insight was that a long boom slides the whole system down that ladder on its own. Stability breeds instability. The longer things stay calm, the more normal it feels to stretch. Smaller down payments, looser documentation, more exotic loan structures. Lending standards end up loosest at the exact top of the cycle, when risk is objectively highest, because the recent data keeps insisting that risk is low. By the top, a critical mass of borrowers needs prices to keep rising just to stay afloat. The system is now flammable. It's only waiting for a spark. Every leverage cycle ends the same way. Something interrupts the loop. Usually it's the central bank raising rates, which lifts payments and cuts off cheap refinancing. The Ponzi borrowers, who needed rising prices, are forced to sell. Selling pushes prices down. Falling prices shrink collateral values, so banks lend less against them, which forces more selling. The loop now runs in reverse. And reverse gear is faster, because fear moves quicker than greed. Then comes deleveraging. Households and firms stop borrowing and start repaying, all at the same time. Remember the time machine. Every repaid dollar is spending subtracted from today. Banks, nursing their losses, tighten credit even for good borrowers. That's a credit crunch. And it's why debt-driven recessions run deeper and last longer than ordinary ones. Now run 2008 through the 4 gears, and a story you already know becomes a mechanism you understand. Gear 1, Easy Credit. After the dot-com bust, the Fed cut rates to 1% and held them there through 2003 and into 2004. Meanwhile, Wall Street perfected securitization, bundling mortgages into bonds and selling them worldwide, so the lender writing a loan no longer carried its risk. Cheap money, and a machine hungry for loans to package. Gear 2, the collateral loop. From 2000 to mid-2006, national home prices rose roughly 80%, and in the hottest cities they more than doubled. Rising home equity became a cash machine. Households extracted hundreds of billions of dollars a year by refinancing, and spent it straight back into the economy. Mortgage delinquencies fell to record lows. The models concluded that national house prices essentially never fall. Gear 3, the quality slide. Subprime lending, about 8% of new mortgages in 2003, reached roughly 1 in 5 by 2005 and 2006. Teaser rate adjustable loans, minimal documentation, nothing down. Textbook Minsky Ponzi finance. Millions of loans that only worked if prices kept climbing, so the borrower could refinance before the teaser rate reset. And the rating agencies, using Lupera data, stamped the repackaged bundles AAA. Gear 4, the snap. The Fed hiked from 1% to 5.25 by mid-2006, and teaser rates reset straight into that wall. Prices peaked that summer, and the refinancing exit slammed shut. The delinquency rate on U.S. home mortgages, under 2% in 2005, passed 11% by 2010. As the AAA bundles rotted, trust between banks evaporated. Credit funds froze in 2007. Bear Stearns fell in March 2008. Lehman Brothers followed that September. The extra interest companies paid to borrow versus the government blew out past 6 percentage points, the widest since the Great Depression. Then came the long reverse. American households did something almost unseen in the post-war record. They reduced their debt for roughly 4 straight years. Every dollar of repayment was a dollar of demand subtracted, which is precisely why the recovery crawled for half a decade. The bust wasn't a different machine from the boom. It was the same machine, running backward. So how do economists spot a credit cycle inflating in real time? 3 gauges, all public. First, credit growth versus GDP. When private debt grows much faster than the economy for years on end, the loop is spinning. The Bank for International Settlements publishes exactly this gap as an early warning indicator. Second, the debt service ratio, the share of income going to payments. Low rates can make huge debts feel light, right up until rates move. Third, lending standards themselves. The Fed literally surveys senior loan officers every quarter and asks whether they're loosening. Years of loosening into rising prices is the signature of Gear 3. None of these gauges predict the day of the snap. They measure how much fuel has been stacked, never the spark. The credit cycle in one breath. Easy credit after a bust. A collateral loop that hides risk while it grows. A slow slide from hedge to speculative to Ponzi finance. Then a snap, and a deleveraging that runs the whole boom in reverse. That's how debt builds the boom and the bust from the same material. Quietly, in plain sight, in public data. If you want to understand the next cycle before it arrives, subscribe. Next time, why the US dollar gets stronger when the world gets weaker, one of the strangest patterns in global finance. This is educational content only, not financial advice. Always consult a licensed professional before making financial decisions.